Welcome back. You're watching Your World at 10. Now, he didn't touch rates yesterday, but the RBI governor made it very clear that the interest rate cycle is turning. Whether rates go up this December or in January, February, March of the first quarter next year, it's very clear that corporate India will have to prepare for a higher rate environment. What does that mean for companies across different sectors? Well, we're going to try and assess that tonight. Joining me, CFOs of three of the leading companies in this country and companies that represent different sectors. Seshagiri Rao of JSW Steel, Ravi Sood of Hero Honda, and A. Subbarao of GMR Infrastructure. Let me begin with the impact on the metals space. Mr. Seshagiri Rao, thank you very much for joining us. The countdown to higher interest rates has begun, Mr. Rao. What do you make of the impact that it's likely to have on your company and companies like yours in the very same sector?
No, the signals have come that the tightening of monetary policy has started. That is clear from the way the credit policy has been announced. But it may happen maybe after 1 or 2 quarters if you look at from now. Why I am saying so, the credit growth in fact has been estimated to be lower at 18% as against 20% originally RBI given the signal. So credit growth is lower in the going forward. Then the second important point is the growth, GDP growth is not revised. It is estimated to be 6%. So taking these two clues into account, even though some changes have been made in the credit policy by increasing SLR, the actual increase in rates may not happen maybe in the next 2 quarters' time. So after that, the tightening may happen because the visibility of the recovery which we are seeing right now, I think it is still not robust enough to tighten the interest rate further.
Mr. Rao, there are some who believe that rates could start moving up as early as December, others who believe it won't happen till March. What's your assessment of when you expect rates to start moving up and by how much? 50 basis points, 100 basis points?
Before March, I don't think interest rates will go up. After that, there is a chance that interest rates can look up. But it may not go up significantly in the year 2010, taking into account the international scenario. A lot of central banks, particularly in the developed world, taking into account the kind of recovery in those countries, they may take more time for increasing the interest rates in the respective countries. Even though inflation is a concern which has to be balanced with the growth. So the growth rate in the next year in India may not be significantly higher even in the year 2010, taking the international economic outlook for the year 2010. So therefore, I expect the interest rates to go up maybe 0.5 to 1% in the entire fiscal year of 2011.
In which case, this should have a minimal impact on your sector through the course of the next year, right, sir? Or a minimal impact, I would say, on most sectors.
Yeah, I think so. If any further increases beyond 1% in the entire fiscal year, it will have an impact on the growth. So therefore, if we have to maintain the growth, I think a balancing has to be done. And internationally, the rates are not expected to go up in several countries. So there is arbitrage also which will arise if the interest rates go up quite substantially in India. So taking this into account, I don't expect the interest rates to move up in the entire fiscal of next year beyond 1%.
All right, so final question. If, God forbid, your assessment is incorrect, as is the assessment of many others out there who believe that there will be no tightening till March next year, if actually rates do start moving up before that and by a larger amount than we estimated, maybe thanks to a quick jump in inflation or something like that, how is that going to impact JSW, other steel companies within your sector? And let me also throw in the rupee wild card because already the rupee has been appreciating substantially over the last 6-8 months. And if rates do actually move up, that could move the rupee up even further.
See, today we have tied up our funding up to 11 million tons. So entire brownfield expansions which we are planning, they have been tied up. But any greenfield projects which we would like to review in the next year. So today enough liquidity is there in the market. But the bank loan markets internationally still not opened up. But the bond markets, convertible bond markets are still open for the Indian corporates. The equity markets are quite okay in India. So taking that into account, I don't think there is a problem in raising funding in the next year. And interest rates I don't expect to go up. So taking these two things into account, next year there is a possibility of funding opportunities for the Indian corporates. If inflation goes up quite substantially, which is, in my view, unlikely to happen, because the international economy, if we look at, it doesn't say that inflation will go up significantly in the next year, in the year 2010. So that will give a comfort that the interest rates will not go up quite substantially, either in India or in the international markets in the year 2010.
All right, Mr. Seshagiri Rao, thanks very much for joining us. Like I said, Seshagiri Rao of JSW Steel. Let's shift our attention now to the consumer sector. And joining me next, Ravi Sood of Hero Honda. Mr. Sood, thanks very much for joining us. He hasn't changed or moved rates up as yet. He's pushed that potential opportunity to the first quarter maybe of next year, as many people read it. What kind of impact will it have on a company like yours to be able to raise money in this changing rate environment? And of course, a company like yours also because it depends on consumer financing.
You see, the problem what we have seen in the last 1 year is that in spite of very, very low interest rates or so-called interest rates, there has been a lot of difficulty in companies raising funds. I'm not talking of very, very large companies or, blue chip companies. I'm talking of like, in our case, a lot of our vendors have not been able to raise money because in spite of the fact that, there has been 100,000 to 150,000 worth of reverse repo where banks are getting only 3.25%. I think according to my mind, the main fear with the minds of the banks has been, regarding the long-term financing. I mean, even we see today, 10-year yield is at about 7.25 plus. It has been, so which means long-term funding is one thing where banks are concerned because they don't know how the interests are going to move in the times to come. And as I told you earlier, there are many, many instances where some of our vendors and have not been able to raise money. And as you are aware, as far as consumer financing for two-wheelers is concerned, that has been an area of concern for last almost 2 years. That in spite of tremendous amount of liquidity in the system, things haven't improved even in the last 6 months.
Mr. Sood, the auto sectors have put in a stellar performance in the last couple of quarters, especially the last quarter that just went by. What impact is it going to have on sales, on demand, if rates do move up, let's say in December this year or January next?
You see, as I stated, our sales are driven, they used to be driven by about, say, 50 to 55% by the consumer financing. But in the last 1 year, the financing has come down to between 20 to 25%. And as I said, there has not been any improvement in the last 6 months. I think a time has come where people are buying more and more of two-wheelers. I'm not talking of autos. Autos still depend, say, about 70 to 75% on financing. As far as two-wheelers are concerned, a consumer is buying a lot on cash, and which is very, very clear in the last 1 year. In spite of consumer financing going down from 55% to about 20 to 45%, the industry has grown, and sales volume of almost all the players have grown.
All right, so what you're saying, Mr. Sood, is that in effect, if rates do go up, whether they go up in December or Jan or Feb, you don't expect it to have any kind of substantial impact on two-wheeler sales, and in fact, you are encouraged by this bet on growth that the RBI governor has taken by not moving rates up immediately. Am I correct?
Oh, yes. I'll agree with you fully.
All right, Mr. Sood, thanks very much for joining us. That was Ravi Sood of Hero Honda. Let's now shift our attention to A. Subbarao of GMR Infrastructure to get a sense of what impact this will have on the infrastructure industry. Mr. Rao, thanks very much for joining us. This quarter, your company took a big hit on increased or enhanced interest rate costs, or interest costs, so to speak. What's your reaction to the fact that the RBI has signaled very definitively the beginning of its exit policy and the reversal of the interest rate cycle?
Yeah, it's pretty scary to think that the interest rates are going to be higher than the current levels. Even now they are not low. As the kind of project finance rates that we are getting from the banks are anywhere around 11-ish kind of rates. So the higher cost is going to stifle the growth, and it is scary, pretty scary to think that interest rates are going to be higher and unaffordable levels. It is going to stifle the growth. It is going to make the projects which have been bid now on the basis of a lower interest rates as of now unaffordable, uncompetitive as we go along.
So I won't get into the debate on, why the Reserve Bank needs to begin its exit strategy, why they need to maybe hike rates to fight inflation, simply because we don't know if rates are likely to be hiked in January or in December this year or in March next year, as Deepak Parekh I was talking to indicated that he doesn't expect rates to go up at least till March. What is your assessment of when you expect to see the first upward movement in rates, how large that's likely to be, and really what you can do to be able to mitigate that, considering that the fundraising window, at least when it comes to equity and overseas money, continues to be open right now?
I believe fundamentally RBI is not going to do any damage to the growth, and they are going to balance between the growth and the inflation. And I think only when the inflation rises its head and the RBI is going to do something on the interest rates front. We have to wait and see. If the first condition is the inflation. If the inflation comes up, so then only I believe RBI is going to do. Otherwise, RBI will not do anything. Even then, my sincere request to the entire system is to manage the supply side and flood the market with adequate supplies rather than increasing the interest rates and hurting the growth process. But looking at the scenario, by all counts, by March the inflation goes to a kind of 6-ish levels, and that is the time perhaps RBI goes to the textbook method of increasing the interest rates. But if the inflation comes from the food products, I do not know how by increasing the interest rates RBI is going to contain the inflation. I have my own doubts on this.
Sir, what will, let's say, a 50 basis point or 100 basis point hike in rates between February and March next year mean to your business and businesses like yours in the infrastructure, construction, development area?
See, a short-term rise in the interest rates for a short period may not impact much, though the sentiments will become extremely bad. The capital markets will get affected, so the markets will climb down because of the fears of the lower profits, and the ability of the companies to raise the capital in the capital markets, that will be dented. So this, on one hand, you have the dented ability to raise the capital. On the other hand, the profitability will go down. And on long-term projects, say infrastructure projects are long-term. If the interest rates are higher for a shorter term of 6 months or 1 year, it's not going to affect the viability of the projects on a long-term basis, but it is going to impact the sentiment very adversely.
So what can you do at GMR, sir, to be able to prepare or mitigate against this definitely potential rise in rates, whether it happens in Jan or March?
Yeah, one option is to, if the dollar financing rates, if they come down, I think the Indian Inc. has to go out and borrow and hedge the positions fully to, as of now, you can raise the ECBs and fund the rupee expenditure. If the same system continues, and if the overseas interest rates come down, I think there's one option all of us have to fund the projects.
All right. Many thanks, Mr. Subbarao, for joining us tonight and giving us your perspective. That was A. Subbarao of GMR Infra. And with that, we've got you views from 3 different sectors on the impact of a change in the interest rate cycle on India Inc. We need to take a quick